Now we're continuing with the second part of the Phase 1-7 slide video. This is on analytical procedures. This is a key concept you need to make sure you know. We use analytical procedures to highlight accounts that are most susceptible to fraud. What that means is we do a horizontal analysis, we do a vertical analysis, we do ratio analysis, we compare to industry, and any accounts that we do like a ratio analysis, and any accounts or ratios that kind of stick out, that don't seem to make sense, we would highlight those as an account that is most susceptible to fraud, particularly financial statement manipulation, that type of fraud, fraudulent financial reporting. SAS 99, which is a Statement on Auditing Standards, requires. Auditors must. Whenever you see the word must, that means it's required, and that means you got to know that. Auditors must perform analytical procedures on sales revenues. Okay, so that's one account where we have to do some specific analytical procedures. So we would compare it to last year, for example. If we see significant bumps in sales revenues without some type of reasonable explanation, that would be an account that we would highlight. Or if the sales revenues increase significantly in relation to a level of inventory, that may be unusual, or level of receivables, those types of things, we would highlight that account as susceptible to fraud. Now, there's a great story about the great salad oil scam of 1963. What this guy did is he wanted to show that he owned more salad oil to bump up his assets on his balance sheet. And what he did is the auditors came out to count the oil, to actually measure the oil, and they would go to one big tank and they'd drop a line down, they'd take out the oil, they'd measure it, they'd measure the circumference and the diameter and all that stuff, and they'd compute the amount of oil within that tank. Well, while the auditor's moving from one tank to the next, they had pipes from one container to the next, and they'd pump it out of the first one that the auditor already counted and pump it into the next one. So when he got to the next one, he would count the same oil. Well, the reality is, if he had done some analytical procedures looking for potential fraud, he would have discovered that based on Mr. DeAngelis's balance sheet, he indicated that he owned more salad oil in those tanks, these are out in the Midwest of the United States, than existed in the whole world. What that means is the auditor did not understand the industry, didn't realize that there's no conceivable way that Mr. DeAngelis could have as much oil, salad oil, as he says he had. And so that's why one of the reasons why we have this particular standard to test revenues is due to the example, the great salad oil scam. Okay, so anyway, that was one way that the auditor got scammed. He wound up counting the same oil more than once. So do your analytical procedures, particularly you must do it on sales revenue. We'll do it on a lot of accounts, but this is one required by auditing standards. Okay, so based on what you learned so far, you may have already highlighted some fraud risks. Okay, so you document that in your work papers, and that will influence the tolerable misstatement, the R factor they call it, that's used to multiply against materiality to get to tolerable misstatement, which is then allocated down to the various accounts. So what should auditors do if they identify risks of material misstatements due to fraud? They should discuss it with management. You don't keep this to yourself. You're in this as a team with management to get these numbers right, so you would discuss those findings with management. Ask management what controls they put in place to prevent these potential frauds that you've identified. How should auditors change the conduct of the audit? This is key. Make sure you know what to do. If you've identified areas of fraud risk, what do you do about it? You can assign more experienced audit personnel. So in other words, if it's really risky, if you think there's a lot of risk regarding the existence of inventory, you don't put someone right out of college over inventory and have them audit inventory. You might put an experienced senior, like someone who's been there 2 or 3 years, to audit inventory. Okay, somebody who actually has done inventory audits in the past or have some experience. And you can increase the unpredictability in your audit procedures. So for example, let's say they have 15 warehouses, and your audit procedures say you only need to go out and test 10 warehouses. You may choose not to tell them which warehouses you're going to go to and count and just show up. Another thing you can do is you can do what are called surprise audits. Now sometimes these can kind of rub the client wrong, so use it appropriately, but you have every right to say, hey, I'd like to test your cash right now, like your petty cash if you have some concerns about fraud there. So I'd like to test it right now, and they would have to reconcile it right then. So you become a little more unpredictable. If they know what you're going to do in all your audit procedures, then they can look ahead and create fraudulent documents or things to kind of hide their tracks. So become a little more unpredictable. Okay. What else can you do? Design procedures to address those specific frauds. So if you believe that inventory is disappearing and the client is not catching that, then you might design specific procedures to ensure an appropriate count of those inventory items. Okay. Now, there's what are called subjective measures. Subjectiveness is, for example, one of the big liabilities on a company's financial statements, if they have a defined benefit pension plan, is the amount of liability they show on their books that represents how much they think they'll have to pay out when their people retire. That's a defined benefit pension plan. Well, some of the measurements in determining how much that liability should be will be based on how long they think their employees will live after they retire, what the rate of return is on the investments that they're going to use to pay for those retirement benefits. And so what some companies will do, they'll it's kind of subjective, right? They can say, well, I think everyone's going to die at 65, whereas another company may say they're going to live to 80. So what you got to do is you got to watch out for what's called a bias. If every time it comes down to an estimate, they make an estimate that causes net income to go up, that is a bias. It's a bias towards fraud, or a financial statement bias to make numbers look a certain way. So you watch out for stuff like that. Okay, and you can design and perform procedures to address management override of controls. In other words, what do you do to address the concern that management is kind of taking over on the controls? For example, management can record top-level adjustments. That means you take your trial balance, and then on top of the trial balance, they put in top-level adjustments before it gets to the financial statements. Well, that's an override of all the controls underneath. So you would make sure you design procedures to test any top-level adjustments. Any accounting estimates, you look for biases. If every time it comes down to estimating, let's say useful life, they choose a useful life that causes the expense to be spread over many more years than normal, or they estimate that people will live a shorter time, or they estimate that there's no permanent impairment in their fixed assets, those types of things. You'd perform procedures to test that. And then also try to understand their business rationales. Okay, why are they doing what they're doing? Okay, and that will help you address maybe some of these potential frauds. All right, so that's the Phase 1-7 PowerPoints. I hope that this is helpful to you. And that's it. Aloha.